Good morning. My name is Behl. Welcome to Behl's Business Broadcast, where we're going to talk about business, finance, economics, and all things related to growing your business, debottlenecking yourself, going from where you are to where you want to be every single day, Monday to Friday, 10 a.m. Central Time, live. So let's get started today. The first thing I want to talk about is the actual economic conditions right now. And let me pull up my screen to show you what we are talking about here. The first thing I want you to understand is that we are looking at Federal Reserve being expected to cut interest rates despite shutdown and causing shutdowns causing data blackouts. That's happening right now. Why would Federal Reserve cut down rates? Where are the rates going? Federal Reserve. Okay. Well, there are several factors to look at here. You have high interest rates for a while, right? You have high unemployment, unemployment rates, despite having high interest rates. You still have really high prices. Inflation is high. Things are way too expensive right now compared to what they used to be even 5 years ago. Inflation is one of those things that the cat is out of the bag. It happens once and the prices never go back down. So even if the inflation rate goes up and the inflation rate comes down, when you have low rates of inflation doesn't mean the prices have gone down. The prices, on the other hand, continue to keep rising. It just happens so that the higher prices don't rise as much when you have periods of low inflation, but the prices are still rising. So Fed is forced to keep the interest rates high. So we have conflicting information on both sides. You have high unemployment, you have high prices, right? Prices are pretty high, pretty steep. You also have pretty high rates right now, and that really seems to have brought down inflation a little bit, but that's about it. It doesn't really help much with anything else. And based on that, you have conflicting information on whether or not you're going to have higher interest rates going forward or lower interest rates going forward. And that is the crux of this session, this particular session that we're going to discuss in this session right now, because that affects your business, that affects your investments. And one of the fundamental laws that we follow here in all my businesses, or at least I like to follow, is that you don't have a crystal ball. This right here is a crystal ball, okay? And you don't have it. Nobody's got it. It does not exist. Nobody knows what's going to happen in the future. However, there are patterns. And one of the patterns that you can always observe is that cat's out of the bag. Interest rates can be increased or decreased. Federal Reserve can increase the interest rates or decrease the interest rates. And that just keeps varying. But one thing that never fails to occur is more money printing. That is always going to happen. So you're going to have more money printing happen in the near future. That's for sure. When this happens, you cannot predict. But when they have money printing, which is inevitable, because what else are they going to do? They're going to just let people have no money whatsoever. That's not a political solution. A political solution would be one that has at least some degree of success, perceived success. And Trump is going to likely want some degree of perceived success or some degree of control over the economic conditions of people in America. So he just wants to have this quick win regardless of, and that's not just Trump, by the way, that's every politician. They just want to have a quick win regardless of the long-term consequences. So you're going to have quantitative easing. We don't have that right now. We only have quantitative tightening that has gone on for a while. Currently tightening, right? What that means is Wall CL, which is something you can track on something like TradingView or the federal balance sheet, right? This balance sheet has been going down for a while. And this affects you whether you're a businessman, an investor, just a job seeker, or or any combination thereof. Balance sheet goes down, that is known as quantitative tightening, of course, right? Tightening has been taking place for a while. And since there's quantitative tightening going on right now, everything seems to be very tight. However, what we have now is a federal sort of holiday, which typically always comes back with some mix of quantitative easing and money printing and reserve lowering the interest rates. Here's what that means for you. People are going to have some surplus cash after a long time. People haven't had surplus cash for a while, but they're going to have some surplus cash after a long time. And you can see that typically. Let me show you. Let me try to pull up the graph. Let's go back to the screen. So you can see that happening right here with TradingView. Let's look at Wall CL first of all, which is balance sheet assets, total assets of the Federal Reserve. And you can see since April of 2023, they've been going down. And that thing has been going down. It's been climbing down. And if you look at how steeply it's been climbing down, that's essentially a 25% reduction in the federal balance sheet over about 3 years. So for the past 3 years, Federal Reserve has been tightening their reserves or tightening their balance sheet. In other words, they've been selling assets. If you've been feeling the pinch, it's because of this. When Federal Reserve increases their balance sheet, as you've seen in the past, right? This is the post-COVID era right here, okay? Post-pandemic era. COVID-19 started right about here and Federal Reserve started printing or, money printing, the cycle of money printing and quantitative easing started, and they literally more than doubled their holdings, right? The Federal Reserve balance sheet more than doubled in about 2 years, 2.5 years, right? That was when you had the era of massive alt seasons, massive business successes, massive everything. And as a consequence of that, we've still had that. Like S&P 500 is making all-time highs all the time. We have temporary crashes. They're like 5%, 10%. But these are not major crashes, even though SPX investors think they're massive crashes. They're not. And people keep predicting there's going to be a long-term crash or a huge, massive crash. But that's not been the case right now. And I can tell you what's going on based on the historical precedent. So if you look at this chart, not on a daily basis, but on, let's say, a monthly basis, right? This is what happens. This is what this chart looks like. So we've had, for the first time, maybe second time, and this was in 2017, 2018, for the second time since 2003, we've had quantitative tightening, serious quantitative tightening, which has gone on for a prolonged period of time. And you can also see the shape of the curve is changing. We're tending towards a minima where it looks like it might tend upwards. But again, I must reiterate, I don't have a crystal ball. Nobody has a crystal ball. The crystal ball does not exist. This thing right here does not exist. Okay. So we don't know what's going to happen. But what is likely to happen is if they don't lower the interest rates and if quantitative easing does not happen anytime soon, you're going to see a lot of panic, a lot of disrest in the markets. Interest rates are pretty high. You can also see the data related to real estate. What's happening right now, there's sort of a glut. No one's calling it that just yet, except me. But there's sort of a glut. People are not really buying property. Why? The interest rates are high. The payments are pretty high. Even compared to just 4 or 5 years ago, the interest rates are insanely high. People are forced to buy properties. If you're forced to buy properties, you're looking at 6-7% per annum interest rates, and nobody wants to pay that. In other words, that also means you can afford a much smaller house than you could have even 4 or 5 years ago, even though your income might have gone up somewhat in that period. So you have a lot more properties on the market with sellers not budging on the price. Why? They have low interest rates that they're locked into. They understand that. They're locked into 2%, 3%, 4% interest rates, and the current interest rates are pretty high. So if they sell and buy another one, they're going to be forced to lock in a mortgage at a much higher rate. So they're not really in a rush, even though they'd like to sell. In a lot of cases, the only people making those deals are people who are who are kind of desperate because they have to relocate for jobs or for some other reasons. They don't really have a choice. They're making deals. And across Zillow and other platforms like that, if you go to those platforms, you can see rate cuts on universally all properties and properties that have been on the market for months and months, and inventory is going up. And all of that is unsustainable. You have higher interest rates, you have higher unemployment rates. Interest rates are coming down. And typically what follows is quantitative easing, but that hasn't happened yet. And there are talks about Trump giving a $1,000 incentive to all Americans in about 2 months, 3 months. You don't know what happens. Nobody knows what happens. Nobody has a crystal ball. But you can predict that sooner or later you're going to have quantitative easing, because that's the only way, politically sound way, in the short term that they have for it. It's not a politically sound way in the long term, but it is going to happen. Now, here's what that means for your business. Small businesses especially skyrocket when quantitative easing happens, okay? Quantitative easing is linked with more sales. Let me get this. More sales or more revenues, okay? It's linked with high markets or high SPX, alt seasons if you are in crypto. And it's linked to basically just a great big gravy train, okay? A great big party situation. People are shopping for fun. And that's kind of what will allow Donald Trump to say, oh, look, we solved the economic crisis. We had this economic tightening going on. We had this economic crisis, but we've solved it. How have we solved it? Just by printing more money. That's what they always do. That's what they're going to continue to do. And that is going to continue to happen. So let's refresh this. I should be logged in. I'm not logged in. I don't know why. Maybe I got kicked out. So that's the first thing. Markets are ripe for... And let's quickly also look at S&P 500. It's been making new all-time highs. Oh, look, that's a new all-time high right now as we speak, $6,875. That's a new all-time high as we are speaking. And these things are happening despite quantitative tightening. SPX is making a new all-time high despite quantitative tightening. Nobody's dancing around. You don't see people on Twitter, on money Twitter, on finance Twitter, on crypto Twitter, throwing massive boat parties or bragging about how much money they've made or posting screenshots of millions of dollars they made in 64 hours or whatever. But you're going to have that. That's typically known as blow off top, right? We don't have the blow off top right now. Another thing that should act as an indicator is Bitcoin reserves. And recently, Bitcoin reserves at centralized exchanges have come to a near 10-year low. In other words, centralized exchanges have a very small amount of Bitcoin reserves, which they hold typically. And this reserve amount is at a 10-year low. And that means we are going to have a supply constraint. A supply constraint means higher prices. Even though Bitcoin is trading near all-time highs, way above where it was supposed to be. Same thing with SPX. This is despite quantitative easing. This is despite you having higher interest rates. You have quantitative tightening right now. Okay, QT. You have interest rates that are super high. You have a glut sort of in the real estate market. Despite all of that, what you have right now are conditions that look kind of unnatural, okay? Look at this, SPX, all-time high. Who could have thought? Quantitative tightening and all-time highs don't go together. Bitcoin recently made an all-time high of, how much was it? $125,000, something like that? Yeah, let's look at that. So Bitcoin recently made an all-time high of 125,000, something like that. Despite quantitative tightening, despite high interest rates are far from all-time lows. This means inevitably when we have quantitative easing, you're going to have fun, I'm going to have fun, our business is going to have fun, and it's going to be a tight window. But if you take advantage of that window, if you do things right, if you line up your ducks correctly, you stand to gain enormously from the upcoming quantitative easing. And that is what we're going to talk about next, how you can position yourself to gain enormously from that quantitative easing. So let's talk about a few fundamentals here. And when we talk about fundamentals, I have to talk about business fundamentals that I always care about. And the first of those is the principle of 80-20. I literally cannot overemphasize the importance of 80-20. Okay? 80-20 is the Pareto principle. We've all heard it. We've all thought about it. We all like to think that we understand it completely, but maybe we don't. 80-20 is not just about time. It's not just about attention or effort. It's about the one thing. And let me explain what that means. When people think about 80-20, it's mostly like, oh yeah, if you did 80% of the things that you do, or 20% of the things that you do, if you took down 80% of your workload, you would still have 80% of the results. That's kind of true, but that's sort of a very lame interpretation of that 80-20 principle. So how do we apply it and how do we really understand it? Well, the first thing is time. Let's say your business is making $5 million a year, $2 million a year, $500,000 a year, $50 million a year. The one thing you cannot put more of into your business is your time, because you are always going to have 24 hours. That's your upper limit. Everyone else has 24 hours, so you're not unique in that regard. Everyone has just 24 hours a day. That includes your competitors who are playing the same field as you are. That also includes much bigger players in your market who have 10 times as much money and influence as you do, who have 10 times the scope, who have 10 times the, or 100 times the revenue that you have, 100 times the reach that you have, 100 times the market that you have. And that's not necessarily a bad thing, if you ask me. That's actually pretty good, because what that means is you don't need to spend more time or effort on your business to grow it, to scale it from wherever you are now to wherever you want to go, wherever you need to go. Now, there are upper limits to how large a business can grow, but those upper limits are not really much of your concern, because those upper limits have to do with the size of the market. So if you're at that position, that's a quality problem to have, but you're typically not at that position, right? You're typically trying to grow your business from some point to some other point. And the principle of 80-20, or just the principle of hard limit of number of hours that you have in a day, states that increasing the amount of time that you spend on your business is not going to help it. Now, I'm not saying you won't have to spend time or energy or effort on your business. You're going to have to. What I'm saying is spending more time or more energy is not always the solution. Spending the time and energy that you do spend on your business on the right things that matter, that is the essence of 80-20. The right things, okay? And I'm proposing investing a disproportionate amount of attention and effort, and of course time, on things that truly move the needle in your business. And you have to figure out what those things are. You have to figure out what your key performance indicators are. You have to figure out what it is that if you do every day, your business grows. What it is that you can do to scale your business from where you are to the next level. And we'll talk about the application and the methodology of that. You have to figure about, and then we'll also talk about the one thing, because it's typically just one thing you can do right now to scale yourself today, or start scaling your business today. And that one thing, if you choose correctly, is going to make a whole lot of difference, and it's going to have rewards for you in perpetuity. You're going to be rewarded in perpetuity. You're building equity, a long-term equity, or maybe a permanent equity, at least as long as you own that business, until you sell that business, and you're going to be still rewarded by that equity by doing the right one thing. It doesn't have to take more time than you have. Most people are worried that it's going to take more time than you have. But as an entrepreneur, you know, you have to solve your own challenges. No one else is coming around to help you. So you have to solve your own challenges. You got to figure out what that one thing is. And we'll talk about how that works. But the important thing is compounding, the principle of compounding. So you choose the right things to propose or to invest a disproportionate amount of attention and effort therein, and you're applying 80-20 correctly. That's the way to apply 80-20. It's not about, hey, what is the list of things I can outsource or delegate? That's just a small part of it. That's also sort of a lame interpretation of it. The right interpretation of it is all about disproportionately putting your money, putting your time, putting your energy, your effort, your attention, your problem solving skills, your charisma, your charm, everything you've got into the right things. When you do that, the 4-hour work week eventually becomes a reality. Not in one day, maybe not in 1 week, not in 1 month, maybe not even a year, but eventually, in a few years, you can get to a point where your business takes care of itself for the most part, and you're really only involved in some of the things. So what's the way to apply this? Well, the way to apply this is something known as the bottleneck method. I want you to sit down and take inventory of what you do all week long. And you have a lot of work to do as an entrepreneur. But there would be some things that completely stand out. This is what I spend most of my time doing. For instance, talking to clients if you have a consulting business. This is what I do with most of my time throughout the week. Now, in a way, you're providing a service to your clients, right? If you're a consultant, you're really just providing service to a client by talking to them all week long, right? But delivering that service doesn't make you money. What makes you money in most cases as a consultant, as a service provider, is by acquiring more clients, charging more money, and then keeping those clients satisfied for a long duration of time so you have a long-term relationship with them. In fact, the fundamental business equation is this. Fundamentally, business amounts to this. You have the lifetime value of a customer. Let me pull up the screen. You have the lifetime value of a customer, and then you have the lifetime value of a customer, and then you have CAC, customer acquisition cost. Okay? This is the amount of money you make per customer. So this is your revenue per customer, revenue per client, revenue per customer, or maybe even the net per client, right? You multiply this with the number of clients. Okay, number of clients. And then you have, that's your profit, basically. That's your bottom line. Top line, bottom line, depending upon whether your lifetime value is based on top line or bottom line. That's it. That's the fundamental business equation. So the only variables there are lifetime value, which we'll talk about in a minute. Then you have customer acquisition cost, and then you have number of customers. That's all you can do. Increase the lifetime value, try to optimize the customer acquisition cost. We're talking about optimizing. We're not talking about reducing it or minimizing it. We're talking about optimizing. Why? Because the other multiplier is number of customers. If you want to pay almost no money to acquire a new customer, which a lot of business owners seem to want to pay no money to acquire new customers, well, what happens is you can't get a lot of customers without paying money to acquire customers. I'm a huge proponent of actually spending money where it makes sense, whether it's in your personal life or business life. I'm a proponent of spending money where it makes sense. And it makes sense to spend money on acquiring customers. So if you want to spend money to acquire customers, there's going to be a certain customer acquisition cost. And if you try to minimize that too much, or if you try to bring it down to zero, like a lot of businesses do by, oh, we only work through referrals, we don't advertise at all. Well, guess what? That's not something to be proud of. What you're really saying is you cannot compete in the cold traffic market to be able to acquire new customers. Is that a great position to be in? No. No. And then eventually you're going to be pissed off at your customers for not being loyal to you. You've seen these business owners all around you. They're pissed off at their customers. He bought from me for 20 years and now he switched to this big company which helps him save a dime. Yes, they're in the business of watching out for themselves. Everyone in business is in it for themselves. They're not in it for you. They may like you, they may even trust you, they may even love your products and services, but at the end of the day, they really just truly care about themselves way more than they care about you, and that goes for everyone. Even your family members in most cases. Exceptions, of course, exist, but for the most part, they care about themselves more than they care about you. So if you want to maximize the lifetime value, and if you only have a certain number of hours per week, Well, guess what? The biggest mistake you can make is tying that lifetime value of each client or customer to your own time. If you're harboring this disillusion or misapprehension, if you basically delude yourself into thinking that if I don't spend time with my clients, they're going to end up leaving me and they're not going to have the greatest lifetime value, or my business is not going to achieve the greatest lifetime customer value without you investing your time in each of your clients and customers, you have already put an upper limit on your business. Your business cannot go beyond the number of hours you can spend on it. It's pretty obvious, right? If you can only spend 20 hours a week talking to clients, customers, patients, whatever you have, then your own time becomes the hard ceiling on the amount of money your business can produce, on the amount of revenue and EBITDA your business can produce. So your customers' lifetime value, your business's customers' lifetime value must be disconnected from your own time. It has to be. Otherwise, you cannot scale. You cannot scale to the level where the market itself becomes a ceiling, which is a great problem to have. You have capitalized the entire market and then you have to look at other markets to get into. But that's probably not your problem right now. Your problem is your time is getting bogged down by serving your customers. So don't waste your time serving your own clients or customers. That's just an enormous drain on your energies, an enormous drain on your time. And that's literally something that you cannot recover. Time is the only thing that you cannot recover in your life, right? If you waste that time just taking care of problems that your clients and customers have, you cannot recover from that. And I see this all the time. Restaurateurs who think they are great at hosting restaurants, well, it depends also on your ambition, right? So if your ambition is small, if you really want to run just one restaurant or one bakery or one cafe or one bar, sure, go for it. Spend all your evenings at it. But then don't complain about not being able to scale. We're really talking about scaling businesses. And that way that works is you have to disconnect your own time from everything, whether it's acquiring new clients or increasing the lifetime value of your clients, especially servicing your clients, because you only can service a certain number of clients that way. And if that is the case, that must match your ambition. If your ambition is making, let's say, $2 million a year, and you can do that by just spending time with your clients, great, good for you. You're not going to be scaling to 20. You want to scale to 20, disconnect yourself. So that's the first thing. So those are the only three things you can do to increase the number of, or increase your bottom line, top line, both of them altogether. The other thing is customer acquisition cost. Of course, your lifetime value has to be greater than your customer acquisition cost. But what matters a significantly great deal more is your break-even period. So if you're spending, let's say, $500 to acquire a client, or $50 to acquire a customer, or $15 to acquire a customer who buys something for you for $50, right? What's your break-even period? If you spend the money today, when are you going to get it back? That's your KPI. That's your greatest KPI in business if you value your time and if you want to grow. If it takes you 6 months to recover the money that you spent on acquiring a customer, well, guess what? You're not scaling as fast as someone who can break even in 6 weeks. And if it takes you 6 weeks, guess what? You cannot grow or scale as fast as someone who can break even in 6 days. And if there's someone who can do a day zero break even, ethically, morally, legally, while building a lifetime value, while building customers like lifetime value, while building a relationship with the customer so that they keep coming back to him eventually, well, that guy is going to scale. That guy or gal is going to scale. So that's your main KPI. The other KPI is number of customers. And you know what? Both of those KPIs do not have any correlation with how much time you spend serving your clients, your customers, your patients. Hire other people to do that. Automate your products and services to do that, because that's how it's going to be. So we're talking about how to position yourself or how to position your business in a way that you can take full advantage of the upcoming quantitative easing. When you have quantitative easing, businesses will flourish, especially if they're well positioned, and that equity will be built over time. Well, these are the two KPIs to keep in mind. Break-even period. How long does it take for you to acquire a new client from cold traffic, from someone going from knowing absolutely nothing about you to becoming a customer, a paying customer? That's your break-even period. And how much time it takes for them to spend enough money with you so that you have a break even on the advertising costs, on the customer acquisition costs. That's your biggest KPI. The other KPI is how many such customers can you get. So obviously the math on this is not very hard. If you have 10,000 customers, right? If you have 10,000 customers, multiplied by lifetime value is, let's say $500. That's bottom line. And it costs you $200 to acquire them. That's your customer acquisition cost. Well, you can do the math on that. $300 times, that's $3 million, right? $3 million profit. But the reason why break-even period is so important is because it allows you to compound. You can take some of your profits or just reinvest your marketing budget. And if your break-even period is small, let's say 1 week, then if you have a $10,000 marketing budget, well, guess what? It becomes a weekly cycle, right? You can take the $10,000 that you've just broken even on, reinvested the subsequent week, and now you've got $520,000 of annual marketing budget just by reinvesting the $10,000 you invested initially, right? And you keep acquiring those customers. And guess what? It's just the break even. You still have the back end to profit on because we're talking about lifetime value, right? Lifetime value can be much more than customer acquisition cost. So lifetime value gives you greatest amount of equity long term. What can you really do to acquire more customers? Well, trust the algo. Trust the algo. We're going to talk about this over the next few streams, but you got to trust the algo. Why you got to trust the algo is because, hey, what else will you trust? The algorithm is great. The algorithm knows your customers inside out. So let's talk about the algorithms, right? Let's say Insta or Meta algo. Well, Meta knows more about your customers than I do. Meta knows more about your customers than you do. Meta knows more about your customers than they do. Meta has, or Facebook has, hundreds of thousands of data points about your customers. So you're trying to sit there in Meta advertising ad center, business ad center. You're trying to pinpoint, oh, these are the exact interests my customers have. Guess what? You're increasing your ad costs because you're targeting a tinier sliver of the market instead of going broad. And you're at the same time limiting your reach. You don't want to do that. In other words, for most cases, even for niche businesses, just go broad. And how does the algo know whom to serve your ad to? Well, the algo depends upon the content, right? Content of your ads and the feedback loop. That's all the algo cares about. Content and feedback loop. How does that work? Well, Meta can go through the content of your ads, whether it's video ads or text ads or photo ads. Meta knows the content of the ads, and based on that, it can understand the context of those ads. And since it has 100,000 plus data points about each of its users, okay? It has all these data points about its users. It can match the content of your ad and the context behind that content to the 100,000 plus data points it has about the users and serve your ads to people it thinks will respond to those ads. And by responding, I mean interacting. Facebook is only interested in interaction. Their KPI, you have to understand Meta's KPI. Their KPI is engagement. Okay? Are people engaged? Do they look at your content and engage with your content? That's all their KPI is all about. They don't care about whether they buy from you or not, even though Facebook is great at identifying people who will buy from you based on the various objectives you can have. And we'll do a deep dive into it eventually in one of our live streams. We might even have an expert on stream to show us how it's done. But for now, suffice it to say, if you just target broad and put out relevant ads, you're already there. You're doing better than most people trying to run meta ads. Why? Because you're not over optimizing. Guess what? It saves you time, money, energy, effort. I'm giving you a shortcut here. Okay, take your content, present it in terms of ads, right? Just your content in terms of ads, make offers, and let Meta take it to whoever it will take it to. You just want to target by age, country, basically demographics, age, country, gender. That's it. In most cases, sometimes language. But again, Meta already knows the language of your ad. Meta already knows the language any particular user actually can speak or understand. And so they can do the targeting pretty well. The other thing is, of course, feedback loop. So if your target is getting more customers, and if your objective on meta ads is aligned with that, Facebook knows how much money you're spending on your ads to acquire a customer, and even your ROI, if you tie it in properly. We'll talk about that. Talk about how to do that in another stream. But Facebook knows. And they can obviously come back and look at refining that feedback loop. Oh, so this is the kind of people that respond well to this ad. They're not only engaging with it, but they're also buying and producing results, which means this particular advertiser can spend more. And that's what Facebook wants, you to spend more money. That's what you want, to be able to spend as much money as you can because you're breaking even as quickly as you can. Those are your KPIs. Never forget your KPIs. For scaling, your main KPI is the break-even period. Okay, that's your main KPI. Number of customers you acquire, that's your other KPI. And the third one is how much time am I spending and what am I bottlenecked by? So that's our third topic for the day. Let's talk about bottlenecking, right? You are absolutely bottlenecked. Everyone is always bottlenecked. And what are you bottlenecked by? So bottlenecking or debottlenecking is not about increasing capacity. It's about using the resources at your disposal right now and using them more effectively, or building strategic alliances with other people who might have the very assets or resources that you might require to scale your business, but those assets are typically unused for them, but you can make good use of them. That's basically one creative way of debottlenecking. The first thing you have to identify is where your time is going. Time is the most important thing in life and business, right? Especially if you want to scale your business. Time is the one thing you cannot scale. Everything else you can scale. You can scale your ads, you can scale your employees, you can scale your teams, you can scale your locations, you can scale everything. You really just cannot scale time though. And if your time is being wasted on a bunch of stuff that other people can be doing for $10, $20, $50 an hour, then you're not going to be scaling. So look at where your time is going. So for instance, I just wasted like 60 hours setting up a tech studio, which I could have paid someone, whatever, $3,000 to do it for me. Okay. And in retrospect, of course, hindsight is 2020. So I know I should have done that, but I did not. And that's a failure on my part. And despite of that, I'm going to tell you right now that I should have done that. Someone would have charged me $50 an hour to set it all up for me, and they would probably be an expert at it, and they would probably get it done instead of 60 hours in 10 hours. So it would really only cost me $500. So I really should have let them do it for me. In a lot of cases, I end up doing things that I shouldn't be doing, like coding. I'm not good at coding. Why am I coding? Why am I trying to use Claude Code? I have no idea. I've never coded in my life. I'm not an IT guy. Why am I wasting time with Claude Code? Right? Someone else can run it for me, unless it's a mission critical application that I have to, do it myself or hire people and do non-disclosure agreements and strong agreements and non-competes and stuff like that. I should just let other people do it for me. It's just an algorithm they're trying to code. Let them do it. Let them do the iterative debugging. I don't have to do it for myself, and I don't have to do it for my business. In a lot of ways, you're doing a lot of things that you should not be doing. If you're just sitting there like an operator, I knew this truck driver guy, right? He's sitting there like an operator. He gets into his office 6 a.m. every day. Why? Because the trucking business starts early. He's in New York time zone, right? He's in Pennsylvania. Gets there 5:30, 6 a.m. every day. Stays there until 3 p.m., 4 p.m. every evening. In his business, he's spending 10 hours a day. Most of his time is not going towards scaling his business. His big problem was he did not have drivers. Okay, his problem was he did not have drivers, but instead of spending his time hiring more drivers, he was just taking care of operating the small fleet of trucks he already had. And he could have just paid $80,000 to someone else to come in and act as an operator. 90% of his day would be saved. He could be spending most of his time then scaling his business, which would mean hiring more drivers, but he wasn't doing that. Why? Well, who knows? Who knows? All we know is he was doing that. And when he came to us, we told us as much: focus your time on finding the thing that is bottlenecking your business right now. And he's like, oh, I go out to all these rest stops and talk to drivers. And that's how I get my drivers. Well, guess what? Do more of that. Instead of sitting behind a phone and a computer and trying to act as an operator, you should be spending more of your time doing what? Well, going to rest stops and talking to drivers and just giving them incentives to come join your fleet and then buy another truck and put more money in your pocket. Every driver he put on the road put at least $50,000 to $60,000 a year net of all taxes in profit in his pocket every single year. And yet he was spending more time, like 80% of his time, just being an operator, which he could have outsourced for what? $80,000, $70,000 a year, $100,000 a year. As soon as he would hire an operator to take care of the operations and train them, he would have an entire day free for himself to go out and hire new people. That was his bottleneck. And eventually he would run into some other bottleneck. That's the other thing about bottlenecks. If you take care of one, you run into something else. So eventually he might have found out that I'm spending most of my time just hiring drivers, but this is not something that requires my own time, money, and attention. I can just hire someone else to do that for me. And he could have hired 5 full-time guys to do that for him and another 2 guys to buy him the rolling stock, which is trucks, which is flatbeds and stuff like that, right? Well, now he's playing a completely different game, but I guess he retired without playing that game whatsoever. So there you have it. Every business, including yours, has a particular bottleneck, and that can easily be identified by you having to spend time on it. Another friend of mine, great big lawyer, very famous, right? Most of his time is still to this date being spent on talking to clients. Literally, that's it. Clients just want to talk to him, the celebrity advocate. He's sort of famous for a particular kind of practice, but he does a whole lot of other things that people don't know about. But one thing that we actually talked about a lot was his YouTube channel, and he scaled his YouTube channel, and he has 100,000 plus subscribers now, and he has no dearth of new clients. His big problem right now is not that he cannot get more clients. His big problem is every client he gets wants to talk to him, at least occasionally, even though he now has a team of, I think, 50 or more advocates working from his office, from his chambers, whatever, right? So he's got this problem. And the way to solve that is, of course, well, debottlenecking. How can you do that? Have a systematic onboarding process, right? But it's going to take some work. He's going to have to spend some time doing that, but he's going to have a systematic onboarding process. Maybe he can do a weekly, 5-minute call with the clients instead of a massive call, right? Or he doesn't have to do those calls if he can completely disconnect his time from his business, from the service of clients in his business. That's the one way to scale to a level that he cannot even imagine right now. Now, I don't know the particularities of his business, and I cannot be sure that that is even possible, but he can definitely cut down his workload related to talking to new clients and existing clients by at least 50 to 70%, and that would help him scale his business higher. The other thing that he is doing well in his particular case is charging more money for those personal consultations and personal conversations. One-on-one direct, not personal, but one-on-one direct consultations, he's charging more money for those. That's the other thing you can do. If the market will sustain it, if the market will allow it, you can charge more money for it, for your own time especially. But for the rest of it, he can do packaged products, because in a lot of cases, it's just other lawyers taking care of most of the work. people who work for him instead of him taking care of most of the work. So that's what he should be doing. So you got to find out what your time is being spent on. Now, we are also running e-commerce businesses. So let me share my own story with you. What my time is being wasted on right now and what my bottleneck right now is dealing with the fucking suppliers. Okay? The suppliers who are not in America are just not great to work with. And I've tried to work with a bunch of suppliers. I thought just having optionality would solve this problem. It really doesn't. And when you think about that, I'm spending so much time on dealing with suppliers and trying to get the inventory into my warehouses on time, or at least manage a semblance of regular flow of inventory, despite having great payment terms and great relationships with these suppliers. It's just their whole thing. They have other things that affect, other factors that affect their ability to supply on time. And since I'm dealing with that as a downstream effect, the one thing I can do right now, and this becomes obvious, right? The one thing I can do right now is hire someone to deal with these suppliers. Why should I be wasting 20 hours a week, 15 hours a week, 10 hours a week dealing with suppliers when I can hire someone full-time or part-time to take care of this who's an expert at logistics management, supply chain management? I can just hire someone for $100,000 a year and they'll take care of dealing with all these suppliers. And that just instantly unlocks my ability to scale. That's my problem right now. And if you think about where you're spending most of your time every single week, you're going to unlock the ability to scale to the next level. It's just inevitable. That's how it goes. So that brings me back to the interest rates. Now, if you look at the ticker on the screen, it says Vol CEL, which is the federal asset sheet, is still down. SPX is still up. Bitcoin is up. It's close to all-time high. SPX is really close to all-time high. But if you look at other stuff, Ethereum, Solana, and other stocks except NVIDIA, they're not close to all-time high. Gold is close to all-time high, right? Everything else, the small caps, the mid caps, they're not close to all-time highs. And what that means is that people have less confidence in smaller stuff, or people are less risk prone or more risk averse right now than they would be when we have quantitative easing and lower interest rates. When you have that, you want your business, if you want to scale your business in the next cycle of quantitative easing, then what you want to have is your ducks lined up. You want to have your ads ready to go. In fact, you want to have your ads running successfully and your break-even period consistently going down, ideally towards break-even on day zero. So if you spend $10,000 on advertising today, you make enough revenue to have at least gross profits of $10,000 or more, so that even before you have to pay off your credit card bill on that advertising expense, your revenue covers you. And that allows you to scale infinitely. That becomes a money machine and an ATM. That's the first thing. The second thing is you must disconnect your own time from the things that are taking up most of your week, really. You only have 24 hours and you don't have to work. That's something that I have to keep reminding myself. I don't have to work for 12 hours a day for my business to just sustain, for my business to grow. I don't want to work 12 hours a day. I used to think that I need to work 12 hours a day, but I don't need to. You don't need to. We don't have 10 times as many hours as we are putting into our businesses today. Which means in order to scale our business by 10x, 50x, 100x, we are going to have to disconnect our own time with the things that propel our business forward. So if I'm spending time on my suppliers, or you're wasting time on onboarding or on acting as an operator or dealing with customers and clients, find ways to disconnect your time. At least most of it, if not all, if all is not possible in your business. I don't know your business. You know your business better than I do. You'll always know your business better than everyone else. No one has a crystal ball. You'll never know the future, but you do know quantitative easing is coming. People will have more money and they will be lining up if your products and offers are good enough. And you want to position your business in a way that you're able to handle 10 times more customers. Are you? 10 times higher revenues, 50 times higher revenues. Are you able structurally, do you have the structures to enable 10 to 50 times more customers, more sales, and take care of those people? Those are not problems to solve.